Good afternoon, investors and corporates. Welcome to SET Digital Roadshow third quarter 2022 performance review. This session will learn about 45 minutes, including Q&A. Company will start the session by 30 minutes presentation, followed by 15 minutes Q&A. During Q&A, investor may leave your questions in meeting room chat box or use raise your hand function. We will open your microphone so you can ask the question to the company directly. May I now invite Thai Oil Public Company Limited to start the presentation.
Thank you very much, Pat. And good afternoon to all of you, and welcome everyone again to Thai Oil third quarter of 2022 presentation. And before we begin, let me introduce the key speaker from Thai Oil. We have Kun Phornpiman Srisatabut, Commercial Planning Manager, and Kun Piyatida Ploypadit, Assistant Manager, Investor Relations, and Min Nichudayon Lengdunrong, Investor Relations Managers. And we also have our management joining us today, Kun Thawsang Chaiprawat, and she's a Financial Planning Vice President, and she will support in the Q&A session. And now let me start the presentation with the key highlight in Q3. And in Q3, Thai Oil, we performed well, reflecting from the positive net profit, but we faced challenging market environment. So our net profit was marginal net profit. And from the softening in the market, it's mainly because the first factor is the concern over economic slowdown following a massive interest rate hike in response to high inflation and coupled with the zero COVID policy in China. And I would say that these two factors pressures global oil demand growth. And secondly, the export quota from China. China announced the last batch of refined products export quota total around 13 million tons. And this pressures oil market, particularly gasoline and gas oil market. And however, there are supportive factors from low product inventory. It's still below 5-year average. And you can see that the middle distillate inventory was much lower than 5-year average. And this can support the market. And from the challenging of the market environment, as I mentioned, so in Q3, our GRM and GRM normalized from the peak in Q2. But I would say that both GRM and GRM still above the pre-COVID level. And from the drop in the crude oil prices, Thai Oil, we faced the stock loss around 9 billion Thai baht in the third quarter, pressuring our bottom line. And importantly, we would like to highlight the success of the recent transaction. I mean the equity offering transaction. We successfully execute the best offering by the end of September and the over allotment by end of October. And the total proceeds from this equity offering was around 10.4 billion Thai baht. And as you may know that we use this proceeds to repay our remaining bridging loan that we took on for the olefin investment last year. And on the next page, let me quick recap the key performance for each business unit. Starting from refinery business unit. In terms of the crude oil prices, you will see that Dubai went down Q on Q from the market concern over economic slowdown. And that resulted in our stock loss in Q3, $9.6 per barrel. But for 9 months, crude oil price went up year on year. So you will see that we booked the stock gain, $4.5 per barrel. And in terms of our GRM, we reported market GRM $6.7 per barrel, normalized from Q2 at a peak of $25.1 per barrel, mainly from softening products margins and the higher end crude oil premium. And for 9 months, we reported GRM $12.9 per barrel, improved year on year. And next, for the aromatics and LAB business, from improving aromatics margin, both PX and benzene margins, which mainly from the lower feedstock costs and also the limited supply from the maintenance. So in Q3, we had improving aromatics and LAB contribution, 20 cents per barrel. And for 9 months, the contribution was 30 cents per barrel, lower year on year, as aromatics market under pressure from the weak demand in China. And last business unit, the lube bed business. In Q3, lube bed business contribute strong GIM, $1.9 per barrel, higher Q on Q from 80 cents in Q2, mainly from improving base oil and bitumen spread from the lower in feedstock cost, which is a high sulfur fuel oil. And for 9 months, lube business contribute $1.1 per barrel. It's lower year on year, as the lube spread last year was very strong from the supply tightness. So if we combine all margins from 3 main business units, so in Q3, we reported market GIM $8.8 per barrel, lower Q on Q from $25.6 per barrel in Q2. And if we include the stock loss, so our accounting GIM in Q3 was lower to minus $0.7 per barrel, lower Q on Q from $33.4 per barrel. And next, moving on to our key business highlight. I would say that Thai Oil, we continue to actively enhance our business on 3 key focus areas. The first one, in terms of operation, Thai Oil, we optimize our production as a group production. We still maintain high and reliable utilization. And in Q3, we had lower refinery intake to 104% due to the softening product spread and scheduled maintenance of some upgrading units. For example, hydrocracker unit and hydro desulfurization unit. And for aromatics and LAB and the lube utilization, it was lower as well due to the group optimization. And if you look at the production yield in Q3, Thai Oil, we increased the jet production to 17% of the total production from 14% in Q2, mainly to capture the recovering domestic jet fuel demand. While we produce the diesel lower as a result of the scheduled maintenance in upgrading unit, as I mentioned earlier, and we produce diesel 32%, lower Q on Q from 37% in Q2. And for gasoline production, it remained unchanged, 19% of total production. And second, on the commercial side, Thai Oil, we focus on the sale in domestic and CNB market. And in Q3, we can capture more than 97% in local market and CNB market. And the remaining for export, only 3%. And moreover, we can capture the gas to oil switching demand by maximizing domestic gas oil and fuel oil supply to power plant. And in terms of crude purchase, we import crude from Middle East as a majority, around 87% of total crude slate. And the rest, 13%, mainly was the local crude, around 9%. And 4% we import from the Far East country and Africa. And third, in terms of the financial side, as I mentioned earlier, we successfully execute the equity offering, and we received the total proceeds around 10.4 billion Thai baht. And we use this proceeds to repay our bridging loan. So after we complete this transaction, our gearing ratios improved from previously higher than 1 time at the end of last year. After we complete the recapitalization plan, our net debt per equity was lower to below 1 time. It's according to our internal policy. And in terms of our shareholding structures, after we complete the transaction, the percentage held by PTT remain unchanged. Both direct and indirect holding from PTT remain about 48%. And after we completed the equity offering, we announced the interim dividend, 2 baht per share, and the payment date will be on 25th of November. And in addition, we continue to enhance our working capital by extending the credit term with PTT from 30 days to 90 days. And that could help release the working capital and ensure our liquidity. And next, moving on to the net profit contribution on the next page. In Q3, we reported net profit 12 million Thai baht, lower Q on Q, mainly from the stock loss, 9 billion Thai baht. And if you look at our core operating profit in the dark blue color, it's remained healthy at 5.5 billion Thai baht. And for 9 months, we reported strong net profit, 32.5 billion Thai baht, mainly from improving in core operating profit from higher refining margins and also stock gain. And in terms of the contribution in the pie chart on the right, you will see that in Q3 from the strong in refining margins. So the majority contribute from refinery and lube sector, around 90%, and the rest 10% mainly from power 7% and other business 3%. And similarly, in 9 months, the majority of contribution was from refinery and lube business, 90%, and power 5%, and other business 5%. And moving on to our strategies, I would say that Thai Oil, we have set the goal to transform our business to become sustainable petroleum and petrochemical company. And to achieve this goal, we drive our strategic direction through 3 key strategies that we call 3B strategies. And the first V value maximization. This is to integrate our hydrocarbon value chain from crude to chemical. And from refinery, we strengthen our refinery through the CP project. And the current progress of the CP project is 88% as of Q3. And this year, we expect to complete the major construction on site, and commissioning and testing will start 2023. And we believe that we should be able to gradually start the operation for the main unit like the CDU by the end of 2024, and for the full operation by early 2025. And from our refinery, we extend our value chain into the olefins. We invest in Chandra Asri or CAP. And for this investment, Thai Oil, we have been working closely with CAP on the CAP 2 project. And we expect that CAP 2 project will FID by end of this year, and COD will be on 2026. And after the FID of CAP 2 by end of this year, Thai Oil, we will inject the second tranche of the additional of $270 million by early next year. And in addition, we look to move up from the commodity into the high value products or HVP. And Thai Oil, we set up the new department to take this responsibility and to set the HVP roadmap and also to collaborate with our partner. And for the second strategy, the V value enhancement, this is to integrate our supply chain management to build the platform to expand into the region and also move closer to our customer. And what we have done in the third quarter is we rebrand Top Solvent company to Topnet to be our international marketing arm, and we identify our target country to expand sale and marketing distribution into Indonesia, Vietnam, and India. And we also continue to participate in the Project One. It's a project that is a collaboration project in PTT Group in key 4 areas. The crude purchase, the product export, chartering, and hedging. And that's for the second V. And the third strategy, the V value diversification, to diversify our portfolio into the power business and more stable income, and also to build a new S-curve business to match with the future trend through the CBC. And for power business, we tag along with the PTT Group. And Thai Oil, we have our own power plant, and we have the expansion project for the top SPP. And I would say that this project still on track. And moreover, we also focus on the new S-curve business and focusing on the 2 key areas. The first one is the biofuel. We are now studying the biofuel, particularly biojet and biochemical. And the second area is the new energy and mobility. We are now exploring the hydrogen technologies and other technology that would help in terms of carbon reduction. And before moving to the next session, I would like to quick recap on the key event in the third quarter in terms of the award and recognition. As shown in the slide, in Q3, Thai Oil, we were recognized and honored by various renowned organizations and institutions, both national and international, through the award and acknowledgement covering operation, management and finance, investor relations, and particularly sustainability. And for example, the SET Award of the Sustainable Excellence for 5 consecutive years, and Thailand Sustainability Investment or TSSI for 8 consecutive years. In addition, we continue to focus on ESG and sustainability. We continue to take care of the community and society around our refinery and focusing on the healthcare and communities. And that's conclude for the key highlight in the third quarter. Next, let me hand over to Khun Piyatida to walk you through the performance analysis part.
Okay, let me start with refinery business. As Khun Shuriyon mentioned that the utilization rate of refinery dropped slightly from 112% to 104% in Q3 due to softer crack spreads and planned maintenance of some operating units. However, our utilization rate still above 100%, which supported by higher domestic demand, which you can see from the top right chart that total oil demand increased almost 18% year on year, led by higher diesel and jet demand from improving economic activities, as well as higher demand for power plant following high gas price. And in terms of sales breakdown, majority of our sales is to PTT OR, which is 45% in Q3. And we still maximize domestic sales at 86% in Q3 and only 14% export. The majority of export is to CLMV country, which accounted for 11%, and the rest is to other countries like Singapore. And then let's move to refinery margin. In Q3, refinery margin was softer from 25.1 to $6.7 per barrel from the two main reasons. First reason is from softer product cracks spread. As you can see from the table that the all product cracks are lower, mostly due to softer demand on concern over global economic slowdown and China's zero COVID policy. And the second reason is from high crude premium, which increased by almost $3 per barrel from Q2 to $10.5 per barrel in Q3. And let's move to aromatics. First, the contribution to GIM is $0.2 per barrel, which increased by to $0.2 per barrel Q1Q. The reason is from improving PX and benzene and also LAB margin due to softer feedstock price. And our utilization rate of aromatic is around 70% in Q3. And for base oil, contribution to GIM is double from $0.8 to $1.9 per barrel in Q3 from increasing base oil and bitumen margin due to lower feedstock price. And let's look at the overall margin. In Q3, we report market GRM at $6.7 per barrel. And with the stock loss from lower crude stock price, the accounting GRM is minus $2.9 per barrel. And if we combine margin from aromatics, LAB, and lube business, our market GIM in Q3 will be $8.8 per barrel, and accounting GIM will be minus $0.7 per barrel. And for group cash costs, our company still maintain at low level. You can see that in Q3, our cash cost is $2 per barrel, which consisted of operating cost of $1.2 per barrel and interest expense $0.8 per barrel. And for power business unit, the contribution is 476 million baht, higher Q1Q from higher contribution from top SPP due to higher gas price. And for this quarter, we received dividend instead of profit sharing from GPSC, as our shareholding in GPSC changed from 20% to 10% end of May, and the dividend received is about 56 million baht. Let's move to olefin business that we have invested in Chandra Asri by Top Investment Indonesia or TII. In Q3, we report net loss of 9.8 million USD, which is equivalent to net loss of 351 million baht. This is mainly due to softer olefin spread as a result of weak Chinese demand following China's zero COVID policy. And for the other business units, such as solvent and ethanol, the contribution in Q3 is 202 million baht, which is lower from Q2 due to lower contribution from solvent business from oversupply situation. However, we receive high contribution from ethanol business from higher ethanol price. And overall, we report net profit in Q3 at 12 million baht, lower than Q2, mainly due to softer crack spreads. and stock loss and also FX loss from the Thai baht depreciation. However, we have net gain on financial value of financial instrument about 5 billion baht to offset some loss. So we report a positive net profit at 12 million baht in Q3. And for the cash flow, we have a significant improvement in operating cash flow to around 22.8 billion baht, mainly because of improving net income from higher GIM and higher other adjustment from the gain from GPSC share sales and reclassification. And in terms of investing cash flow, even though we have capital expenditure in major projects such as CFP and top SPP expansion project, but it was offset by the cash flow from partial disposal in GPSC and dividend received, total of 22 billion Thai baht. Therefore, we have less investing cash flow to 7.2 billion Thai baht. And combining between operating cash flow and investing cash flow, the free cash flow is equal to 15 billion Thai baht, which improved significantly from the previous year. However, we have spent cash in financing activities about 23 billion Thai baht, which mainly for loan repayment. And in terms of position of cash, our cash and short-term investment reduced from the beginning of year 2022 from about 30 billion Thai baht to 27 billion Thai baht. And in terms of financial position, as of 30 Sep, we have total asset of 440 billion Thai baht, which is consists of cash and short-term investment of 27 billion Thai baht, as I mentioned in the previous slides. The rest will be current and non-current asset. The non-current asset increase mainly from higher property, plants and equipment from project investment such as CFP, while the current asset from rising account receivable and inventory following high crude oil price. And for the debt side, we had a interest-bearing debt of 176 billion Thai baht, which is equivalent to $4.7 billion. And if we deduct with the cash, the net debt position is about $3.9 billion. In terms of currency breakdown for debt portfolio, the 78% is in USD and the rest will be Thai baht. And the interest rate, we mostly fixed at 81% and the rest is float. And for financial ratio, net debt per EBITDA increased Q-on-Q to 3.6 times due to lower EBITDA in Q3. And for the net debt per equity, we still can maintain at low level at 0.9 times. And in terms of credit rating, 3 of them are still rating us at investment grade. And that's all for financial performance analysis. Next, let me hand over to Khun Phornpiman for market outlook part.
Okay, thank you. So let's move to the market outlook part. And today we are going to cover for the next year outlook, comparing to the current situation and this year. And we will cover for the 4 main sector, which is in oil market, the refinery sector, the petrochemicals, and also the base oil market. Let me start with the oil market first. So on the oil demand next year, we're gonna say like an oil demand still have some pressure from the high inflation and also the China like zero COVID policy. With the higher inflation rate this year, led the many central banks all around the world, like the Fed and also the ECB, to hike their interest rate to the very high level, and some is still hit the record high. So overall, like gonna pressure on the economic activities. While on the east side, China, which is a big consumer in the market, the higher the COVID case, still keep the government to using the zero COVID policy, which is also like send the pressure to the economic activity as well. So in overall in the economic side, let the IMF to revise down the GDP forecast for next year from 3.6% in April to be 2.7% in October revisions, and also let the Energy Agency to revision the global oil demand forecast from April to October revision as well. However, the next year, I mean the 2023. Next year, the GDP growth still at around 2.7%, while the global oil demand is still growth about 1.5%. And this is our best case for the market in the moment. And the growth is led by the Asian side, but maybe weighed down by the slower growth in the US and the EU. And also in the market still keep watching on the recession case as well. The recession case that maybe have some potential to be the worst case for next year. There's a forecasting from the market, which is a flat forecast. The GDP growth next year will be around like 1% growth, and then on the overall demand will be only like 2.9 MEDs. And this is there's still the uncertainty for the demand. And if you look at the supply side, the supply side will be limited as well in terms of the OPEC production. Because if you can see from the chart A, it's only like small incremental in the OPEC plus production next year. And that because of the limited spare capacity. For next year, we still expect the spare capacity of the OPEC members to be only about like 2.5 to 3 million barrels per day, which is considering like low comparing to in the past. So the OPEC production will be quite limited. But if you see on the chart B, there will be some additional barrels of the crude oil supply from the non-OPEC. This is described as exclude the Russian volume, but overall like non-OPEC will be additional about 2 million barrels per day next year, which is forecast, and majority is from the US, which is the investment in the capex is quite increasing comparing to the last year or the COVID year. So overall, the additional barrel from the non-OPEC will be mainly from the US. And the main things, and is the uncertainty things in the market in terms of the crude oil supply is the Russian supply. There's some like forecasting of the Russian oil supply disruption or to be fed down from the market after the sanction deadline from the EU, which gonna happen like in the next few weeks in the December this year for the crude, and also on the product in the early of next year in February. So there's some forecasting like on the FGE or the factory house, the forecasting quite limited impact on the Russian disruption, but in other some house like EIA or IEA, that's quite significant, about like 1 to 1.5 million barrels per day of Russian to be disrupt or to be disappear from the market. And overall, in terms of the demand and the supply side, based on the base case forecasting, we would see the crude oil market next year will be quite balancing or slightly like tighten a little bit. But the market still need to keep watching the two main things, which is the global economic growth and also impact of the Russian oil supply will be disrupted next year. Then we move from the oil market to the refining sectors. So if you can see from the chart, these are the Singapore cracking GRM, and in the Q2, there's like a historical high or the unusual high in Q2 in GRM. But for the Q3 and also the Q4 today, the margin is slightly lower to the normal level or the normal period before move back before the pre-COVID level. So this is mainly from the lower margin, lower mid product cracks as well. And then for next year, we're gonna expect the normalizing the refinery margins, but to slightly above the pre-COVID level anyway. So let's see on the overall picture of the next year capacity addition and also on the demand growth. If you can see from the chart, from 2023, there are quite big additional capacity next year. The net capacity addition will be about 1.5 MBD in Asia Pacific and the Middle East. Mainly the big volume is mainly the delay capacity startup since during the COVID time or 20 and also 21, and to be start up in this year and also in next year as well. But the demand side is continue to be growing as well, so it's quite offsetting the new capacity addition for next year. But after that, in 2024 and onward, maybe there's a limited capacity addition on the refinery side. So let's be down deep into the crack individual products a little bit on the gasoline market first. The gasoline market next year is we're gonna see the steady demand growth and also mainly from the Asian market, similar to like many years in the past, and some pressures by the recession fears maybe got some pressure or limited the upside from mainly in the Western. And also, if you look at in the supply side for the gasoline, the stock or the inventory, like globally, in the chart number 2, it's about the US and the European hub and also the Singapore hub. The stock for the gasoline is still on the lower bound, which is still lower the 5-year average. And yeah, next year maybe there's some gasoline supply addition, mainly from the China, which is after they got the new export quota. So they might have some like gasoline barrels coming to the market to balancing the gasoline low inventory. Then we move to the jet market. The jet market, the key things for next year is still see some of the higher demand from the higher flight number as well, and also increasing the demand during the traveling during the winter. So overall, like year-on-year growth, we still expect the jet demand to keep going up year-on-year. And together with the inventory or the supply side for the jet is still quite low, and also even lower than 5-year average as well, if you can see in the chart number 3. And also on the additional supply, mainly from China, that we are going to see some some barrel for the gasoline. But in terms of the jet, they're quite limited the supply addition because of the jet quota is also including in the higher demand of the air traffic as well. So move to the next product, which is the gas oil market. On the gas oil demand, there's some like steadily high demand following the higher GDP growth. But the key things of the gas oil demand for the next year still be on the supply side as well. If you see from the chart, the gas oil stock is quite low and even really lower than 5-year average. This is leading by the lower refinery run rate like earlier during like COVID period of time. So this is that's why the stock for the gas oil looks very low like this. And next year, with the potential of the supply disruption from Russia, there's some chance that the diesel barrel is gonna be disappear from the market after the EU sanction effective on the February next year for the product side. But the limited limit downside from the limit upside from the for the gas oil market will be the additional supply from China, because we're gonna have some like additional volume export from China as well after they get some like quota this year. But we expect the this Q4 and also maybe in Q1 next year gonna see some quite high volume of the gas oil. But the rest of the year, as we expected, there's some improvement of the COVID situation in China. So maybe the domestic demand for China will be a little bit improved, and then the export volume from China will be a little bit less and less. Okay, then move to the fuel oil market. The fuel oil market next year we're gonna see some improving as well, and some part is the gas to oil switching demand, and some part is on the bunker side. And on the supply side, the Russian fuel oil supply is expected to be lower, but slightly lower in terms of the volume, and also quite but also limited additional volume from China. So this is like overall on the petroleum product market. So now we move to the petrochemical side. The petrochemical side is start with the aromatics market. Next year, 2023, may be the challenging year for the aromatic market because of we have like a lot of the capacity addition next year. Even we have some growth in the demand side, but it seems like the capacity quite a lot next year is waiting for the startup. Also both of the charge A, which is the parastyrene, and also on the charge B, which is the benzene as well. But after that, after like the next few years, we would see some like upward trend of the market for the aromatic side because of the limited additional capacity. And also on the petrochemical side, which is the olefin market, the picture is quite similar. We might have some challenging for next year because of the large capacity addition, but we still expect some recovering in the demand side with because we still have some growth on the economics. So overall, like demand and mainly on the China will be improving like for next year. So that will be another challenge here for olefins. And the last market we cover for today is the base oil market. And the base oil market next year gonna be softer from this very high perform this year. Because of next year, we're gonna have some additional capacity of the base oil group 2 and the group 3, which is in the blue bar chart. But we also have the shutting down of the base oil group 1 capacity as well, which is in the pink one. But overall, like the net capacity addition of the base oil both 3 groups. So we're gonna have some pressure on the net capacity addition next year. And a little bit on the bitumen market. Bitumen market next year, the spread market, we're gonna have some pressure because of the higher like feedstock price, because of we might see some improving in the fuel oil market, and also fuel oil, which is a part of the feedstock price. So spread gonna have some like pressure, but overall in terms of the bitumen market itself, there's still some demand growth in the bitumen, if you can see mainly from the China and also in India. So overall picture of the bitumen market year on year will be quite stable. So once again, in terms of the conclusion for the 4-5 market today, the crude oil price next year will be quite balancing based on the demand supply balance. But the two key things we're gonna have keep watching, which is the uncertainty on the global economic and oil demand, and also on the supply loss of the Russia. And also on the refinery side, the normalizing refinery margin is we still expect to be slightly above the pre-COVID level. And some challenging in terms of the petrochemical market, which is the aromatics and olefin for next year, but some hope for the next few years. And on the base oil market, a little bit softer from the quite perform this year. Okay, and this is all the market outlook for today. And there will be the overall presentation from Thai Oil today as well. Maybe if we still have some time, maybe let's move to the Q&A part. Thank you.
Do you have any question? So if have not questions, the session has come to the end. We highly appreciate investors and corporates for joining the conference. If you do need further details, please feel free to drop us an email. Thank you very much. ขอบคุณทางบริษัทนะครับ